Hi everyone, welcome to this market update for January 2023. We're again looking at the data from the CAR, the California Association of Realtors, for the market update in January. Okay, so let's take a look at the Bay Area counties. If Usually the first column I look at is the year-to-year price change, and then as we go through this column here, Alameda County down by close to 15%, Contra Costa down by 11%, Marine it's really bad, 18%, Napa 8.4%, San Francisco 15%, San Mateo County close to 19% down, Santa Clara 11%. So all the numbers here are negative. So that means 3 years into COVID, price gone down quite a bit from January 2022. So over the last 12 months, home prices drop anywhere between 10 to 18%. And month-to-month price change is not that big of a deal because real estate in winter is always pretty volatile. It doesn't really give you much information. It varies county to county, year by year. But overall, compared to the sales closed in December, most of the counties' prices went down. So this downward trend is continuing. Okay, so let's take a closer look at this San Mateo County. 19%, that's pretty steep of decrease. If you round it up, it's actually close to 20%. So that's pretty bad for homeowners in San Mateo, especially those who bought last year. Just in the last 12 months, the equity loss about, on average, $200,000. Actually, no, 20% is like $400,000. They lost in equity, just evaporated in 12 months. Okay, now let's look at the data a little bit closer. So this month, I want to, let's see if I can move this screen up, my face up a little bit. So let's look at the pricing data from the beginning of COVID. So this is plotted multiple counties. Some are in Northern California, some in Southern California, since January 2020, just over the last 3 years. And so COVID started around, like, let's say March, April of 2020. Prices keep going up quite steadily. Went up to the peak around April 2022, and then came down quite a bit. So the straight line here, that's the trend line. So that's just out of all of these data points, this is the overall trend for each of the counties. So one thing that's quite interesting is that if you look at the San Mateo County, this light blue line here, and Alameda County, which is this red line here. So they are quite parallel. So in terms of trend, they are pretty, meaning that San Mateo went up a pretty much the same amount in terms of absolute dollar amount as much as Alameda County. Okay, so that means, okay, in this case, a $1 million home at the beginning of 2020 in Alameda County now becomes about 1.06. Same thing for at the same time, San Mateo 1.42. Now it becomes about 1 point. Let's see, how do I get this number here? It's about 1.625. 1.625. Okay, now if you look at other counties, which counties actually was benefited more from COVID, which is indicated by the more a steeper line. So I believe the number the steeper one I found was, so this one, this light blue here, Orange County it started with a fairly wide gap with Alameda County. Now the gap becomes smaller. That means they are on a steeper slope in terms of price growth. So surprising, huh? After 3 years, our price only went up a tiny bit. And after all of these roller coaster rides up and down, we pretty much back to where we were. There isn't a whole lot of price gain. So in terms of actual number, so I highlighted Orange County here from January 2023. Compare this number with January 2020. Orange County actually experienced a 40% increase in home value. Okay, and then the second one is Sacramento County, very close. California in general is 30% increase. So that's the average number in California. So what are the losers? Everything below 30% is a loser. Everything below the California average. So we have Alameda County 22%, Los Angeles County 26%, San Diego 25%, even Santa Clara County 27.5%. Okay, how about the bigger loser? The bigger loser, we have Napa, San Mateo, and actually not the bigger one, but the biggest one is San Francisco and Marin. So price actually went down compared to January 2020. Over 3 years, home value actually went down. So after this roller coaster ride, San Francisco, this little purple line here, home value went up during the pandemic, came back down as interest rate fell, came back up, and then as interest rate climb again, the home value actually is lower than where it started in January 2020. Now let's take a look at the inventory, unsold inventory in for these counties. So on the left-hand side, we have January 2020. So we have about 4 months, between 2 to 4 months of inventory to start with across these different counties. Inventory went down, real estate market heated up during the pandemic. Now we start to see inventory came back to the same level as just before the pandemic. Alameda County 2.2 months. California overall is 3.6. So in this between between 2 and 3.5 months, that is the inventory that we have. So compared to historic average, this inventory number is still low. Okay, so it's still more of a seller's market than buyer's market compared to historic average. Now let's look at the mortgage rate. So not surprisingly, we had a peak. We had a mortgage 30-year fixed mortgage peak at around October 2020 at 7.08, and then it came back down a little bit and recently ticked up again at 6.5. This is the data coming from Freddie Mac. Let me move myself. Oops. Okay. So remember at the beginning of the pandemic, okay, let me go back to the beginning of the pandemic. Oh, it's not doing it for me. Okay, interest rate started at about 3.72 as the Fed increased liquidity in the market. Interest rate went down. Now we actually almost double of where we started, and so we had the steepest increase in interest rate back in this April. Let's see, it was this March-April period of 2022. That corresponds to where the price peaked April 2022. So that's a time where people really start to believe, and the reality starts to sink in that the interest rate is going to go up. Okay, people make that last push to buy homes before the interest rate go up at a substantial pace. That's when people rush to buy, and then eventually it peaked and then came back down. All right, so now the question is, where is the market going in 2023? After 3 years, we know price went up only 10, 20, in a good case, around 30% for some of the counties after 3 years. You will say, okay, that's actually not bad. If you just do a really simple math, ignore the compounding effect. For 30% increase, you actually have about 10% increase a year in Sacramento. Yes, that's true. That's for counties where during the pandemic people flock to Sacramento. People flock to less crowded area, flocking away from San Francisco, and from the more crowded counties such as Alameda. And Marine is actually quite surprising. Marin and Napa, it actually price went up quite a bit and then dropped back down very fast as well. So this is the indication of the bubble. So when people all rushed to buy in Marin and Napa back in 2021, 22, price also went down substantially as the interest rate picked up. And that's because over there in Marin and Napa, there isn't really a lot of economic activity and jobs compared to the other counties of the Bay Area. So let's take a look here. For I don't have the Marin County turned on. Okay, I guess it doesn't matter. You can tell from these numbers here. Okay, now, so where are we going with this kind of market? So right now, home prices are very sensitive to interest rate. Let's go to the interest rate chart. So when we have the interest rate kind of have a little dip here, okay, we had saw home price actually ticked up a little bit, and actually not home price did not tick up a little bit, but the actual activities in the market, we see the home buyers stop becoming active as the interest rate went down for that short period of time. Home price is going to be very sensitive to supply and demand at this point, and which is right now is very sensitive is more on the demand side. So supply, there isn't a whole lot of factor that will affect the supply right now. It's the demand. Demand is highly sensitive to the mortgage rate. Now, so let's see. Okay, so this is the federal funds rate, and over this one year period, look at this very steady increase of federal funds rate. Only until recently we see a much smaller increase. I think the Fed is still gonna raise interest rate because the most recent economic data from the Bureau of Labor Statistics shows that the CPI, all items less food and energy. Okay, these are food and energy are the sectors that are prices tend to be volatile. So oftentimes economists look at all items less food and energy. At this point, when the market starts to think that, okay, CPI finally, inflation, more specifically, inflation finally peaked, people are quite excited, and people all have this sentiment that, okay, the Fed is going to stop raising interest rates very soon. Okay, and everybody was expecting the inflation to come down very steep. It will come down very in a very steep curve. But Unfortunately, the January number came back at 5.6. It's not like 3-4%. It's still very close to the peak of 6.6, and that's when. So earlier this year, Larry Summer. So who is Larry Summer? Larry Summer is a former U.S. Treasury Secretary. Okay, so this guy he's very vocal about commenting on the Fed's policy, which has a very broad effect on the U.S. economy. So earlier this year, in January, he was a little optimistic that the U.S. economy could avoid a recession, and just a few days ago, he came out because of the most recent inflation number. He came out to say, okay, it looks like the Fed has been trying to put the brakes on, and it doesn't look like the brakes are getting much traction. Okay, so what happened when your brake is not working? You could be heading up for a collision or crash. So overall, the market sentiment is that, okay, the Fed's interest rate high policy is not as effective as everybody had thought. This kind of high inflation is still going to linger around. It's not going to come down to 2-3% anytime soon. So the Fed is likely going to keep raising interest rate for a longer time than everybody has expected. So we expect the mortgage interest rate is going to continue to hover around this 6-7%, maybe go, but not as high as 8% in 2023. So why? Why is as the Fed raises interest rate, the mortgage rate is not going to go up as much? That is because there is something called the spread between 10-year Treasury rate versus the federal funds rate. So this is the spread. You can think of the 10-year Treasury rate as a very good indicator of what the 30-year mortgage rate is. So you take this interest rate minus the federal funds rate. So if it's positive in just like most of the years, that means the 10-year rate is higher than the short-term rate. Federal funds rate is a very short-term rate. It's just basically an overnight rate. So during economic expansion, you expect a long-term interest rate to be higher than the short-term interest rate. So look at what territory we are in right now. We are in negative. We are negative 0.81. Negative 0.81%. That means the federal funds rate is higher than the 10-year Treasury rate. So when does the market go into this kind of situation, right? Last time it happened was 2019, and then before that it was 2006, 2007, up until the end of 2007. Before that is the dot-com bubble. So every time when the economy is in trouble, okay, the market they're all gonna think that the Fed's interest rate is needs to come down. It's over the long-term outlook from the market. So everybody thinks that the Fed's rate is very high right now, but it's gonna last a little bit longer. And so right now, compared to all the previous recession that the U.S. experienced, we are just at the beginning. Okay, we are just at the beginning. We are not close to the end yet. So this period, it's about 2 years. This period, it was about a year and a half, and we are just a couple months into this period. So we foresee that the interest rate will continue to go up in 2023. Not going to be as crazy as this kind of very steep increase, but it's going to be in this 6 to 7.5 range, and that is going to remove a lot of demand on on the market, we will continue to see the inventory will slowly climb to about a 4-month mark, 4 to 5 months, and price will still come down a little bit more. So that is going to be our real estate outlook for the year 2023. This is of course we are very early into the year, and all of the sales closed in January. Actually, they were in contract in December 2022. So this is going to be an interesting year overall. I have told my staff that if you have not bought a home yet, and you should buy something in 2023. So if you still have credit card debt, work hard this year to pay them off. Okay, get yourself into a financial situation where you can take advantage of this kind of home price once in 2 decades kind of home price. Real estate will be a little bit undervalued in 2023. So this is a good time to buy in 2023. Maybe not early, but towards fall or to winter of 2023. I think that's going to be a very good time to buy real estate. Of course, it's very dangerous to make predictions like this because so many things can change. God knows when we are going to have another special operation. That's what the Russia calls it, right? Into special military operation in Ukraine. Events like that is going to impact a lot of things across the entire economy, across the entire world. So whether you like to call it invasion, special military operation, these kind of things are just out of our control, but they have extraordinary impact on not just the economy, not just the housing market, but just everybody's life in general. Okay, so that's it for this market update, and I hope this time this production is a little bit higher quality because I finally managed to get my face onto the screen instead of like last time it was on the side, and we are giving you a maximum screen real estate possible this time. Let me know how I can improve this. Thank you.